Hi everyone, welcome to the BOQ Specialist live webinar on how to manage your business and your finances during the COVID-19 pandemic. This is the sixth in our series, and tonight I'm very excited to have Clive Levinthal from Experien Insurance Services joining us. My name's Tim Bowring. I'm the National Head of Partnerships and New South Wales Regional Manager for BOQ Specialist. I always like to start with a quick ISO story. I don't know if any of you have heard this one before, but I had the absolute pleasure of homeschooling my children for 8 weeks during this pandemic. I think I learned a lot about them. I probably learned a lot about myself. And when they went back to school was probably one of the happiest days of my life. So I'm sure there's a few parents on the line who probably experienced something pretty similar. On a good note, it looks like we've probably turned a bit of a corner in terms of the pandemic and some sort of normalization coming back. I know a lot of our customers are really starting to ramp back up in their surgeries, which is fantastic news. Just before I quickly introduce Clive, we will have a Q&A session following Clive's presentation. You'll see on the right-hand side of your screen, there's a chat box. At any time, you can click on the chat box and lodge your question, and then we'll answer it at the end of the Q&A. I'll quickly introduce Clive. So Clive is an actuary and also holds the Chartered Financial and Analyst designation. He's currently the CEO of Experien Insurance Services, a business he founded over 15 years ago that specialises in advising doctors, dentists, vets, and other professionals on their life, medical malpractice insurance. Experien is a preferred insurance partner of BOQS and has won several industry accolades and has over 5,000 clients around Australia. Clive has held various senior management positions both in Australia and internationally for over 25 years. He has previously been awarded the Financial Services Council Industry Excellence Award for life insurance. So welcome, Clive. On that note, I'll hand over to you.
Thanks, Tim. Thanks for that great introduction, and good evening, everybody. It's a pleasure to be here tonight and to hopefully share some very interesting information with you. Insurance is not necessarily known for being the most exciting topic, but events leading into the beginning of the pandemic were exceptionally interesting in the insurance industry. And the pandemic just threw an extra bit of catalyst into that equation, and we've seen extraordinary circumstances and events taking place. We've also got a reasonable insight into the expected long-term effects of the COVID situation, plus the underlying currents that were leading before it, and I'll give you an insight into what we expect. So the topic is hot topics in insurance and the implications of COVID. Tim has taken you through my biography, so I won't cover that. And just a quick initial commentary that any information I give today is general in nature. It won't take into account any of your personal circumstances, and you should get your own individual advice if you seek to take any action. So what I'm going to cover in the topic of insurance is three areas of what we call complex insurance needs, and that's insurance needs for your health, such as life and income protection insurance, insurance for your practice or surgery or business, which we commonly call business or practice insurance, and lastly, for many of you who are working in the medical sector, I'll cover the important topic of medical or professional indemnity insurance, and I'll cover that specifically for doctors and dentists. So I'll start off with the trends that were prevalent in each of those sectors leading into, say, February, before the peak of the COVID pandemic hit. I'll then take you through what the immediate impact has been of COVID-19, particularly through March, April, May, future expectations, and some tips that will hopefully be useful to guide you in your own situation. So first up, the trends that were prevalent in leading up into February was in the life and income protection insurance space was exceptionally large losses, particularly for income protection insurance last year, and that's been an ongoing trend. So the amount lost was staggering at nearly $2 billion. Income protection, just to remind you, is a product that if you get sick and you're unable to work or you're injured, it will replace some of your income. What's also been affecting that industry and the life insurance industry generally has been low interest rates. Now, that's not good for insurance companies. Low interest rates means that they earn less money on the premiums they invest once they collect it from you. So low interest rates means they would generally need to charge more with their premiums. As a result of those 2 points, we've seen regulatory intervention, which is quite an extreme event and results in dramatic consequences. And I'll talk to what that will be shortly. The life insurance industry has also seen a reduction and a retraction in competition, and that has affected the availability of product and pricing. One classic example has been the exit of one of the country's most well-known and larger insurers in the life insurance space, which is AMP, from that sector. So the outcome of that has been significant price rises that are starting to flow through in the industry, particularly for income protection insurance. We've also seen a large change in the ownership of life insurers. We've seen the banks slowly starting to exit the ownership of life insurers and selling that to other owners. And we've also seen the closure of AMP and the sell-off of AMP's life insurance business. We're also going to be seeing quite material product design changes in the income protection industry because of those losses. One change we've already seen has been that new entrants into income protection, new consumers, have been unable to purchase what is called agreed value income protection policy since 1 April this year. And in addition, there's going to be a further round of changes expected to come through mid-2021, where new policyholders may face the situation where they'll be given a product that the insurer can change the features on globally every 5 years. That's still being worked through, and the final details aren't yet out, but it will mean that new people could face an inferior product design than people that have already got cover. Those that have already got cover are protected and quarantined. The next impact we'll cover is been in business or practice insurance. So that covers your practice if, for example, there's a fire, or if there's theft, or if there's public liability events such as somebody falling and hurting themselves. Insurers have generally seen stable claims in that segment compared to, say, income protection insurance. So we haven't necessarily seen big rises in pricing. Pricing has generally been stable. With the advent of the internet and increased technology, we are seeing opportunists take advantage of people with cybercrime and cyber threats. And we've also seen consumers, unfortunately, not taking up what is quite an important component, and that is called business interruption cover, which replaces the income of a business should it unable to be trading, typically as a result of events that are physical in nature, such as a fire. And we've also seen relatively stable competition in that segment compared to life insurance. So one key trend we have seen is people have been more interested in cyber insurance and protecting themselves in that regard. With professional indemnity insurance, and again, I'm covering mainly doctors and dentists in the space, the other segments such as vets is not as exciting in terms of its developments there. But we have seen for doctors and dentists a massive rise in the number of regulatory notifications made against such practitioners at regulatory bodies such as APRA. As a result of that and other matters, we have seen claims costs generally rising around about 5 to 10% per annum. However, with the insurers that cover doctors, we have seen, as a result of significant government intervention since around 2003, significantly high profits emerging in those insurers. And that has led to some interesting dynamics, which I'll cover later. We've also seen, as a result of that 2003 government intervention, significant financial support for doctors for malpractice insurance as opposed to dentists. And again, that has helped curtail the price rises on doctors' malpractice insurance. Low interest rates has again been unfortunate in terms of pricing in the segment, just like I mentioned earlier, because insurers earn less money on their reserves and the premiums they invest. But we have seen increased competition, particularly when it comes to doctors' malpractice insurance, with the entry of new insurers and increased competition amongst the existing insurers. So unlike business insurance, we've generally seen price rises of about 5 to 10%. We've seen a reduction slowly in the government financial support for doctors' professional indemnity insurance, which is putting a bit of pressure on prices. And we certainly have seen doctors and dentists being more aware that they can shop around and perhaps find better opportunities than previously. Then along came the huge impacts of COVID-19, and that led to some dramatic periods of activity in the life insurance space. Firstly, we have seen, and insurers have seen again, an even further rise in mental illness claims when it comes to total and permanent disability insurance and income protection insurance. Whether that will last for a long time or whether that will be temporary in nature as the economy goes through, hopefully, a temporary dip remains to be seen. We also saw quite a few people rushing to get insurance, fearing the consequences of COVID on their health. And some insurers initially introduced temporary exclusions, but as a result of political pressure and other pressure, those were retracted and people were able to continue to apply for insurance. What made it difficult was for those that were temporarily out of work. Applying for cover at that time can be troublesome because you need to justify your income, and some insurers had concerns with that, and there were delays and consequences as a result. What's also difficult for insurers when a situation like the pandemic hit is that their existing claims are difficult to manage because they might have limited access to medical professionals to help them with claims assessments. And that can cause either claims delays or extra costs for insurers. We've seen interest rates fall even further from their already low levels as a result of government stimulus initiatives, and that again will put pressure on insurers in terms of their pricing. We saw insurers offer a limited amount of hardship support, so that's, for example, premium waivers for those who might have been out of work. But the amount of support was not that material in the greater scheme of things, and partly the reason for that has been those exorbitant losses that the insurers are making in prior years. So that has resulted, unfortunately, in further pressure with the insurers and more impacts on their profitability. And we're starting to see increased shopping around by consumers who are affected financially, to see if they are able to obtain better opportunities with other insurers. With business insurance, it was a very controversial area during the pandemic and still is right now. Firstly, many insured businesses became aware that they didn't have business interruption cover. So even if there was an event such as a fire, they wouldn't have the policy responding to replace their lost income. But what happened with COVID was that insurers had never intended to pay out in such a situation like a pandemic because of the exorbitant costs they would face and possible insolvency. So the intention was always to design their products to exclude an event such as the COVID pandemic. And in most cases, the wording has been designed reasonably clearly, and it allows them to exclude those claims. Obviously, the businesses for whom those claims were excluded haven't been happy, and we have seen some legal challenges commencing. Some of those have gone through the Ombudsman, which is AFCA, and others might go through courts. And we've also seen similar initiatives happening in the UK, where dental practices, for example, have been mounting legal challenges. Now, I think that my personal view on that is that these might only succeed in rare cases and in opportunistic cases where perhaps an insurer's wordings might have been written imperfectly, or a favorable hearing is received by a judge or the like. But I think the intent was certainly not to pay the claims, and I think it's highly unlikely that anything will happen in that regard to have claims paid. We have seen the general insurers typically offering some element of hardship support in the form of deferred payment options for some clients and some customers. But again, the amount of support available has been reasonably limited. We've also seen, as a result of the awareness of the absence of business interruption cover, that clients are more interested in addressing that gap in their cover. We don't expect material pricing impacts to emerge from the events of COVID, unlike we will see with medical indemnity and possibly life and income protection insurance. But again, because of the depressed nature of the economy, we are seeing more shopping around to perhaps obtain cheaper premiums. One of the very interesting areas is that of medical indemnity or professional indemnity insurance for doctors and dentists. The first impact to insurers was that there is probably going to be a period, or there was a period, of slightly lower claims because practices weren't necessarily operational, procedures weren't being performed, and hence there weren't a risk that mistakes will be made. Again, interest rates have fallen even further, and that does put pressure on the insurers and their reserves, and that will flow through the system. And we have seen reasonably healthy hardship support in the form of either 3 months cover being offered by some insurers, and price rises have certainly been very limited this year, or some insurers have not even passed on any price rises. So again, lower interest rates might put some pressure on pricing, but we've seen low price increases certainly with June renewals, but we have definitely seen a greater interest for doctors and dentists to shop around to potentially save money on their indemnity insurances. Now, the future implications are the most interesting ones to think through. Firstly, with life insurance and income protection insurance, there is a greater awareness by consumers of the need for insurance because of events such as a pandemic and the risk of becoming ill or possibly even dying. But there's also the risk that if you leave it too late and you want insurance, you may not be able to get it. Firstly, because there might be exclusions, and secondly, because insurers might dramatically tighten the underwriting requirements and let fewer people in. And also, if your income can't justify your cover, you may not be able to get it. So what consumers rightly want to do now is lock in cover, get in the system now without exclusions. And once they're in, life insurance policies offer an extremely valuable feature called guaranteed renewability. That might change for income protection policies next year, but once you're in, and the insurer can't adjust your policy's ratings based on your own personal situation changes, such as, for example, if you become less healthy, or if you have something happen to your health, or you start smoking, or for example, those type of events. What we will see though is quite large continued income protection price rises caused by low interest rates, but now with the impact of higher unemployment, insurers are more worried that they'll see income protection claims rise, and they have started seeing that. Whether it's from mental illness reasons or otherwise, those claims will certainly come through, and the price rises will be significant. We'll also see customers continue to move away from closed legacy insurers, such as those who may have been insured by AMP, and rather preferring to be insured with more contemporary insurers that remain open to new clients. We've also seen the insurance offered automatically by industry superannuation funds and other superannuation funds rise because of other regulatory changes. So people are now comparing what they're getting for their dollar in their superannuation funds, and potentially considering if there's better insurance options outside of those superannuation funds. With business or practice insurance, we think that insurers will double take on their policy wording to make it absolutely crystal clear about exclusions for events like COVID, but we still see that pricing is likely to be stable in that segment. Just making another point on income protection insurance, where price rises have been quite dramatic and will be quite dramatic. The nice thing about that product is there are a lot of options for consumers to make changes to their policies to reduce their price. For example, by increasing their waiting period as opposed to giving up that very valuable cover. The professional indemnity space could potentially be a huge hotspot as a result of COVID. There is a possibility that people will lodge claims now as a result of not being treated during COVID, as a potential misdiagnosis of COVID and infecting other people, and a range of other items related to COVID that could lead to increased claims. We might even see that as a result of increased unemployment, people will lodge claims against medical practitioners or dental practitioners with a view of trying to get out of paying for those treatments by alleging the treatment was faulty. So there is a risk that claims could spike and hence premiums could spike in the longer term as a result of that. The short-term support given by insurers in this segment via premium deferrals or no or low rate rises or 3 months of cover are likely to need to be recovered in due course. So we might see that in 2021, there's a large catch-up in rates. Low interest rates are also problematic for insurers in terms of their earnings. And again, that will put pressure in 2021 on potential future rate rises. And the government is looking to give its support in the medical sector for their malpractice insurance. They're looking to withdraw and give less money as the profits are really high in that segment. So the withdrawal of government support again might put pressure on premiums, and we might see premiums increase as a result. So what are our top tips arising as a result of all those dynamic changes? Firstly, with life and income protection insurance, if you don't have cover now, particularly for income protection insurance, you should get it before further changes come in 2021 and before new exclusions start being introduced into policies, because once you get in the system, you remain in the system and you're protected from any future changes. With income protection insurance, given that it's such a valuable product and costing insurers so much money, it's important that you set up your policy structure or you adjust your policy structure so that it's sustainable in terms of pricing for the long term for yourself. That could mean that, for example, you choose a longer waiting period or perhaps a shorter benefit payment period, or you consider other changes given the flexibility of that product. Certainly shopping around if you're able to, if you're still healthy and you're able to obtain better terms and or better pricing elsewhere in the industry, it makes sense to consider that. Similarly, for people who've been given cover automatically inside their superannuation and have never had that reviewed by a professional, it is a good time to review that and to see whether that cover remains suitable or whether you have additional options. And a reminder for people who are paying for the insurance premiums themselves, you are in many situations with certain adjustments able to draw on savings in your superannuation fund as a bank account virtually to pay for those insurance premiums. Now, naturally, that will erode your superannuation balance, so you need to think about the consequences of that and get advice in that regard. But particularly if you are cash strapped in the short term, you may feel that that is a suitable solution for yourself and it is an option that you can consider. With business and practice insurance, unfortunately, I can't offer a solution to cover for business interruption for future pandemics. That is just unfortunately an uninsurable risk at this time, but you certainly should consider other high consequence events such as flooding or fire that could interrupt your business and result in it being shut down and a loss of income. We've certainly seen that with dental practices. One of the most common causes of claims are water-related damages, and in many situations, those damages can be extreme and shut down a practice. So having business interruption cover is critical to prevent that type of circumstance. Shopping around can potentially lead to improved features and or lower pricing. And for those of you who are exposed, taking cyber insurance is a very safe option. It typically costs between $1,000 and $2,000 a year. But if your systems get hacked and you have privacy breaches, you might be in quite a pickle if you don't have somebody to support you through that. With professional indemnity insurance, particularly for doctors, you'll see on the next slide, shopping around, if you have faced a reduction in your earnings and you are interested in saving money without compromising the quality of your malpractice cover, shopping around can lead to significant savings. And in light of the very high rise in the number of regulatory claims being lodged by consumers and by employees and other practitioners against practitioners, making sure your regulatory claims coverage limit on your policy is high enough for your needs is something to be aware of. Now, just on the last slide before we move to questions, we can show for an interesting segment, which is doctors' malpractice insurance. What we do is we help doctors compare the pricing they can achieve and the features they can gain by considering several insurers. And you can see that because doctors have generally been apathetic in shopping around, insurers have generally managed to get away with not necessarily charging the most competitive prices. And we find that when we do create a competitive situation, we can result in exceptionally material reductions in a number of cases. Not in all cases, each case is going to be specific, but for a range of specialties and for a range of billings, you can see for doctors that are doing some private practice work that significant savings can be achieved. So hopefully you found that useful in those three important categories of insurance. And I'll hand back to Tim to go through any questions that have come through.
Fantastic, Clive. Thank you. Great presentation. I might, at the end of questions, maybe ask you a couple myself that just I thought of during that. But let's kick over to everyone who's on the line. Just as a reminder, everyone, the chat function is on the right of your screen. If you click the little speech bubbles, you'll be able to lodge a question. We'll get to as many as we can sort of over the next 15 minutes. If there are any that are sort of directly related to personal circumstances, we'll make sure Clive can get in touch with you afterwards. And we'll try to get to all of them. But if we run out of time, we will come back to you after the presentation. Clive, we might just leave the presentation on the screen with your web address, just so people have got it there. That'd be fantastic. First question comes in from Matt and says, are you seeing an increase during this period in take-up of insurance?
Yes, we certainly have in the area of life insurance and income protection insurance. So COVID naturally made people worried about what their personal situation might be if they got sick. And people were also aware that all of a sudden they might not be able to get cover when they finally do decide to get cover. So we certainly have seen people either reviewing their coverage to see are they covered for enough, or even they might be covered by too much and might need to be reduced in cover, or getting into the system while they can get into the system. So yes, for life insurance, income protection, trauma insurance, we have seen greater awareness. And we've also seen more interest in people using their superannuation to rather fund the premiums if they're currently experiencing some short-term cash flow constraints.
Yeah, maybe can you just go a little bit deeper onto that one? What's the difference between funding your premiums via your insurance versus doing it outside of super?
So many people might, for example, pay their annual life insurance premiums as a direct debit from their bank account, their personal bank account. What people might need to do if they are facing short-term cash flow constraints is rather source the premiums from another place rather than giving up their cover. So it's possible to, with a broker, to restructure the policy so that it's technically fallen within the superannuation environment. And that means that if you've got superannuation savings anywhere in any super fund, you can do what's called a rollover from that super fund to pay the premiums, and thereby not draw on your personal bank account savings if you are in that situation. So again, not necessarily suitable for everyone. Some people might be concerned about eroding their balance, but for a number of people, it can literally be a lifesaver in terms of ensuring that they retain their valuable cover, particularly if their health isn't in perfect situation. They can't necessarily get back in the system later, as opposed to letting their cover lapse.
Okay, great, thank you. So during COVID, obviously you talked about the business interruption claims and the pandemic sort of knocking a lot of them out. Have you seen more insurers declining other types of claims during COVID?
I think insurers were initially quite worried, naturally so, about what the consequences of COVID could be, and could there be such an extreme situation that they might even go bankrupt. So I'm sure they were having a number of meetings and crisis meetings when it first happened. The life insurers were particularly worried firstly about the possibility of death claims, and secondly, the possibility of serious income protection claims, particularly when we're hearing stories about strokes and so on. So there was a concern of a spike in claims from those reasons, but also what we see with permanent disability claims and income protection claims is whenever there's a knock to the economy, claims in that segment spike because people are out of work and they want to try to claim on the insurance. So insurers were particularly concerned about that, and also the ability to enable them to get assessments done on people making claims by doctors, because doctors might not be open, people might be nervous about going to doctors, and doctors might have been pulled into the public sector if there was a spike in illnesses from the pandemic. So insurers, I think, were initially quite worried, but a number of their concerns did not eventuate, and we have not seen any signs of insurers being harsh or unfair with claims. We generally find with life and income protection insurance that the insurers are very fair and follow processes appropriately. So no, we haven't seen a declinature in that regard, but we've certainly seen for business interruption claims, insurers' initial positions have been that for COVID-related incidents, the policies won't be triggered in terms of business interruption.
Okay. I got a really good question here from Roy. Just before I get to that, guys, quick reminder, that chat box on the right-hand side, if you've got a question, please click it and drop it in there. So the question from Roy is, could you talk a little bit about the subject of travel insurance and the availability of it during the COVID pandemic, I assume both domestically and internationally, and what that market's going to look like moving forward?
Yeah, so we don't specialize in travel insurance, and one of the reasons we don't specialize in travel insurance is it's a product that leads to an inordinate amount of complaints from people that take the product. Something inevitably goes wrong when it comes to travel insurance, and it's often best for clients to deal directly with insurers in that regard. But I will say this about travel insurance, and that is the view from consumers have generally been that each travel insurance policy is the same, and whether you take your travel insurance through automatic coverage from your credit card or otherwise, you know, it's all the same. But what you should take note of now going forward is whether your travel insurance policy covers you for insolvency of the business or the tourism operator or hotel that you've engaged with. Not every policy is consistent in that regard in terms of covering you, and the travel insurance sector has certainly been very hard hit by the pandemic. Their income has virtually collapsed, so they are finding things quite difficult. And I think that once international travel resumes, whenever that might be, in 2021 or otherwise, we might see quite a different look of the travel insurance industry in terms of who's offering products, how they're designing products, and what changes they might be making as a result of the pandemic. So I think a lot still is to be written in that space.
So do you think, as my cruise ship ticket I've got booked for September going to be covered by my travel insurance?
For your sake, I certainly hope so. But you'll have to take that up with the travel insurer directly.
Excellent. Another one here from Kai. So how far, like obviously there's been a number of rises with income protection premiums over the past couple of years. How far do you think income protection premiums are going to go up?
Yeah, that's a great question, and a difficult one. It has been very difficult having conversations with customers about income protection rate rises, because it is such a valuable product, but yet the insurers are losing so much and needing to pass through these rate rises. So we've seen in the past rate rises of between 10-20% per annum, but this year, unfortunately, we're going to see rate rises of over 20%, which is difficult. But again, the product has a lot of features and options and opportunities to work with your advisor to overcome a large part of that cover without necessarily needing to give it up. So, for example, one insurer is allowing you to, instead of taking large annual increases in your sum insured, which is dangerous for the insurer and you might not necessarily need it for income protection, if you rather take more benign, lower increases in your cover each year, the insurer will give you a 7.5% discount for doing that. So there's a number of those features that are available, some from only one insurer, some from many insurers. But if interest rates remain this low, and they are incredibly low, then unfortunately the rate rises will be there. However, if interest rates rise again in the future, let's say, for example, the government introduces massive stimulus, prints money, and inflation goes up, and if interest rates go up, we will see a reduction, hopefully, in those premiums. That's not good for mortgages, but we will see a reduction in pricing in that space.
Yeah, okay, great. You touched in your presentation around cyber insurance, and I must admit that's not one I've thought about too much. I can relate to it though, because as a bank, we might have a customer whose email gets hacked and there's an invoice that requires payment and a bank account detail gets changed and suddenly there's $100,000 down the drain. It's disappeared. Maybe you can just talk a little bit about cyber insurance and the kind of things it covers you for, because I think even coming out of this pandemic, we're seeing much more media coverage around, scams and frauds and people that are generally trying to take advantage by deception.
Sure. Yeah, it was quite scary to see the opportunism during COVID as a result of people either working from home, having more access to being online, or the inability to necessarily walk over to somebody else's desk and check if something that had been received via email was correct. So we saw a definite spike in attempts to phish or hack or scam. But that won't go away post-COVID, and was certainly there before COVID. And we often see terrible situations where a practice might be hacked and held to ransom. The practice owner needs to buy Bitcoin or other cyber currency. Only if they buy that Bitcoin and transfer it over to the hacker does the hacker release the block to the system. And there's obviously also the threat of very sensitive data, such as patient health information, being threatened to be released unless ransoms are paid. And other damage can take place, and you might even face fines, regulatory fines, because of data breaches. So what good cyber insurance policies do is not just necessarily cover you for the financial consequences of a cyber attack or hack, but they actually give you instant access to, let's call it, their support team or hit team to immediately step in and help you through the process, give you access to people who've got IT experience and obviously experience in this regard. So having access to that if something goes wrong is important. Ideally though, everyone should be set up to prevent that from happening in the first place via whatever systems they need to have in place, such as backups, dual sign-ons, and so on. There's a number of really good tips on how to protect yourself in that regard. But if all your stops unfortunately fail, then having the backup to step in if it does go pear-shaped is potentially a lifeline for many people.
Absolutely. Sorry, you all right?
Yeah, and I'd just add that the take-up rate though of cyber insurance isn't high. So we see everyone insure themselves for public liability in their practices. We see about half of businesses insure themselves for business interruption, which is a really important coverage. So only seeing about half cover themselves for business interruption is a concern. And I would guesstimate that not more than 5% of practices would hold cyber insurance. And it's largely either because of being unaware or just being concerned about paying that extra $1,000 or $2,000 on top of what might otherwise be large insurance premiums being paid elsewhere.
Yeah, okay. That's interesting, because we would absolutely see multiple cases every month of customers who are being impacted by fraud attempts. So it's very prevalent out there.
Yep,
One last call, everyone. Just if you've got any burning questions, click the chat box on your right, and we'll get to it. Just one last one from me, Clive. Obviously, there's a key theme in your presentation around shopping around. Price is obviously very important, and there are some really good examples of savings there. But as important when it comes to insurance, the sort of the benefits or the T's and C's, and a lot of the devil is in the detail. So maybe you might be able to just talk about that for a little bit, and just to close us out.
Yeah, so the devil can be in the detail in terms of product features, and that's where it's quite clear that consumers who use brokers such as Experien versus trying to deal directly with insurers have far better claims outcomes and far better declinature rates or lower declinature rates. So that is definitely wise for having a big brother. And typically, actually, when you use a broker, you land up paying less rather than paying more. A lot of people get worried, if I use a broker and advisor, I'm going to have to pay extra fees. Most of the time, the insurers pay the brokers, and because of the extra efforts of the broker, the price falls down. I guess a last point is just to say that it's this time of year that many doctors are renewing their malpractice insurance, and a lot of doctors are simply on direct debits and will have a very large premium whacked out of their bank account on about the 22nd or 25th of June, even though the policy started on 1 July. It's a great time to revisit that insurance. There's still time, and if anyone wants that reviewed and potentially obtain better benefits or lower pricing, we'd love to assist in that regard.
Fantastic, Clive. Thanks very much. Thanks for joining us tonight. Everyone on the line, thank you for joining us. Thanks for taking time out from your families. Hopefully you've come through this pandemic safe and well. We will be back in another fortnight's time with our partners, Health Project Services, with details released shortly on that. So keep an eye out on our LinkedIn page and our website. Thanks once again, and stay safe out there. Cheers.
Thanks, Tim.